LanzaTech, ticker LNZA, Q2 2026. Revenue missed consensus, coming in at $9 million against a 12.6 to 13.1 million forecast. But EPS massively beat the expected loss.
Yeah, reporting an unbelievable $15.81 per share.
Right. Full-year guidance was reintroduced, targeting 50 to 55 million in revenue and an adjusted EBITDA loss of 22 to 26 million.
And the stock reaction was completely muted, right? Slipping 0.32% to $6.19 pre-market.
Yeah, basically hovering right near the bottom of its 52-week range. Yeah. So, look, help me out here. I'm looking at nearly $16 of profit per share on just $9 million in revenue.
It's pretty crazy.
Unless they found literal gold in their, R&D lab, that math is just totally broken.
Yeah.
Where is this cash actually coming from?
Well, it's not coming from operations, that's for sure. That $15.81 EPS isn't like cash hitting the bank account.
Okay, so what is it?
It's just a balance sheet revaluation. LanzaTech holds an equity stake in this offshoot called SGLT. It's a joint venture focused on aviation fuel.
Right, the one that just IPO'd in Hong Kong.
Exactly. That IPO triggered a $208.1 million non-cash, unrealized paper gain for LanzaTech.
Ah, okay. So the headline profit is essentially just an accounting illusion.
Yeah, pretty much.
So if we strip away that IPO windfall, what are the actual core operations doing? I know CEO Jennifer Holmgren framed this quarter as a, quote, structural reset.
Right.
But what does that physically look like on the ground?
Well, it looks like a very painful, rapid metamorphosis. They are shifting away from being this R&D heavy think tank.
Trying to become a commercial execution machine, right?
Yeah, and you see that in the aggressive cost cutting. I mean, operating expenses didn't just dip, they plunged 67% year over year.
Down to what, 11.7 million?
Yeah, exactly.
I mean, a 67% cut is massive. You don't get there by just trimming the, marketing budget. Are they shutting down labs?
It's a hard pivot. They are dialing back exploratory research programs and restructuring their headcount.
Just to focus purely on projects that generate near-term revenue.
Exactly. By slashing that overhead, they managed to narrow their adjusted EBITDA losses to $7.6 million for the quarter.
Right.
But cutting costs is only half the battle. The way they actually make money is fundamentally changing right now.
Yeah, and looking at their segment mix, I'm seeing a really concerning shift here.
Oh, absolutely.
The high-margin joint development agreements and IP licensing, which, historically drove their growth, those completely plummeted.
Just fell off a cliff.
Yeah, and to offset that, lower-margin engineering services surged 73%.
Right.
It sounds like they're shifting from being the architect who just sells the high-margin blueprints to being the general contractor who actually has to buy the steel and swing the hammers.
That architect analogy is spot on, and the general contractor business is capital intensive.
And highly dependent on execution.
Exactly.
Yeah.
When you rely on engineering services, your margins just get squeezed. Every supply chain delay eats into your bottom line.
Right.
And look at the steep slope they've created for themselves here. They only reported $21 million in revenue for the first half of the year.
Which means to hit that 50 to 55 million full-year guidance they just reintroduced, LanzaTech needs roughly 30 million in the next 6 months.
Yeah.
Wait, 30 million in 6 months when they've only done 21 million so far?
It's a steep hill.
That is a brutal ramp-up for an execution-heavy model. How are they physically going to generate that much cash flow that fast?
Well, they are relying heavily on regulatory catalysts to open up new markets.
Okay, what kind of catalysts?
The key linchpin here is achieving ISCC EU certification for their primary plant in China.
Okay, wait, let me pause you there. ISCC EU certification. Why does a European piece of paper matter so much for a plant operating in China?
Because it's essentially the gold standard sustainability stamp for the European market. Without it, the ethanol LanzaTech produces in China is just standard commodity ethanol.
Right, priced against every other generic fuel out there.
Exactly. But with that specific certification, it legally qualifies as sustainable aviation fuel, or S.
Oh, wow.
And airlines and shipping companies in Europe are desperate to buy SAF at a massive premium to meet their government emissions mandates.
Ah, okay. So that certification is the literal key to unlocking the high-value market.
Spot on.
So if you're looking at this stock, you really have to ask yourself, are you betting on their underlying carbon capture tech, or their ability to navigate European bureaucracy.
Yeah, because right now, hitting those second-half revenue targets hinges almost entirely on regulators.
Wow.
It's a high-stakes bottleneck. I mean, they have successfully proved the science over the last decade.
But now they're trapped in the messy reality of commercial scaling and regulatory compliance.
Right.
And that messy reality creates a fascinating structural disconnect for you to explore on your own.
Definitely.
LanzaTech's entire public market capitalization sits at around $81 million right now.
Which is wild because,
Yeah, because that retained 8.38% equity stake in the SGLT joint venture we talked about at the top of the show. Yeah. That alone is valued at roughly $110 million on paper.
it's a striking paradox. The market is essentially valuing LanzaTech's core operating business at less than zero.
Yeah. So does that accounting illusion mask a dying core business? Or does it highlight an incredibly mispriced asset buried under a painful transition?
It's a great question.
Make sure to follow the show for your daily earnings coverage, and we will see you on the next deep dive.